Welcome to Word on the Street podcast. I'm Alex.
And I'm Elaina.
Today we're doing a deep dive into something you've likely heard about private equity. Sounds kind of financial, maybe a bit abstract.
Yeah, but what recent analysts are showing us is that it's actually a huge force in the real economy. It touches everything from stores you use to maybe even your healthcare.
It's definitely not just numbers on a screen.
No, not at all. And the sources we're looking at today, like a recent labor scorecard, some academic work, online discussions, they give us a pretty varied picture of how private equity works and, really importantly, how it impacts companies and their employees.
Right. So our mission here is to kind of unpack all that, pull out the key insights from these analysts, and help you understand what's really going on when private equity steps in.
So let's start with the basics. What is private equity according to these sources?
Okay, so at its core, right, private equity firms gather up money, often from big investors like pension funds or endowments.
Right, institutional investors.
Exactly. And they use that cash to buy companies. The goal, usually to transform them somehow over a few years, make them more profitable, more efficient.
And then sell them off for a big gain, typically in, 3 to 7 years or so?
Yeah, that's the usual time frame.
Yeah.
And you hear this term leveraged buyout a lot. How does that fit in?
That's like the classic PE move, an LBO or leveraged buyout. It means the PE firm puts in some of their own money, but then borrows a lot more debt, often from banks or other lenders, to actually make the purchase.
Okay, so they're using debt to buy the company. And who ends up holding that debt?
Often the company that just got bought. That's a key part of the structure. The acquired company itself now owes the money that was used to buy it.
Wow. Okay, so it starts life under new ownership, already loaded with debt.
Frequently, yes. And unlike, say, shareholders in a public company who might just hold stock, PE firms are active investors. They take a controlling stake, get seats on the board, get really involved in strategy, operations.
They're not just sitting back.
No way. And even though it's called private equity, they do buy publicly traded companies too and then take them private off the stock market. Some analysts, especially in finance, see this as, an innovation, a different way to manage capital, maybe unlock value that public markets weren't seeing.
An innovation that's, well, it's spread like wildfire across the U.S. economy.
Yeah.
The numbers you pulled from recent analysts are kind of staggering.
They really are. PE isn't just some small corner of the market anymore. I mean, look at the employment figures. PE-owned companies employ millions of people. Over 2.4 million in just accommodation and food services.
The hotels, restaurants, fast food.
Yeah.
Things we all interact with.
Exactly. And then another 1.6 million in retail and wholesale trade. Think department stores, grocery chains.
Right.
Plus over 2 million more in areas like admin support, security, and critically healthcare. It's pervasive.
So yeah, definitely not abstract finance. It's woven into the fabric of everyday services and jobs. And one thing the analyst highlighted was the type of jobs often under PE ownership.
Yeah, that's a really crucial point from one source, the private equity labor scorecard. It found that almost half, 46% of the employees they analyzed at PE-owned firms work in industries where the median wage is less than $15 an hour.
Less than $15.
And get this, 87% work in industries where the median wage is below $20 an hour.
Okay, so that points to a really heavy footprint in lower wage sectors of the economy.
Which brings us right to the core findings of that private equity labor scorecard. It was put together by the Private Equity Stakeholder Project, and they looked at 11 big PE firms, grading them on 10 different labor practice indicators.
Big names, I assume.
Yeah.
And how did they do on this report card?
Well, the results were, let's just say, not great. They used a standard A to F grading scale, F being, failing, less than 60%. All 11 firms got a C or lower, not one A or B in the bunch.
Seriously, all C's or lower, any F's.
Yep. 7 of the 11 got straight F's. And yeah, these are household names in the finance world. Blackstone, Cerberus, KKR, Sycamore, Rourke, CD&R, BC Partners.
7 F's. Wow. So what's the takeaway the scorecard is drawing from that pattern? It sounds like a pretty consistent negative picture on labor practices.
The report argues that this pattern of low scores suggests that, hazardous or negligent labor practices might be pretty widespread, not just isolated incidents. The real insight is how this translates into real impacts on workers, things like dangerous conditions, lower wages, job cuts.
Affecting their livelihoods directly.
Exactly. And the scorecard's stated purpose is really about transparency. They want investors, the public, regulators to see these potential risks, arguing poor labor practices aren't just bad for workers, they can be bad for the firm's reputation and bottom line too. It's framed as a sort of call to action for the industry itself.
A call to what? Address labor rights, promote more ethical practices for
Yeah.
long-term sustainability.
That's the idea. Ignoring this stuff isn't just a social issue, it could be a business risk.
Okay, let's make this more concrete. What specific impacts did the sources document? Layoffs often come up in discussions about PE.
They definitely do. One analysis we saw from the National Bureau of Economic Research focused on retail. It found that retail companies bought by PE saw, on average, a 12% drop in employment over 5 years compared to similar companies not bought by PE.
12% fewer jobs in retail, which is already tough.
Yeah. And the labor scorecard. It flagged specific firms with high rates of mass layoffs. Subaru-owned companies apparently had the highest rate among those studied, over 13 mass layoff events per 1,000 employees.
Those numbers are stark, but the individual stories, they really hit home. The sources mentioned Toys R Us. That was a big one.
Oh, yeah. That's just a devastating example. KKR and Bain Capital bought Toys R Us in an LBO. The company ended up saddled with, $5 billion in debt and eventually went bankrupt.
And the workers.
Yeah.
People who've been there for years.
That's the really tragic part. According to the source, long-term employees, like one woman, Cheryl Claude, who'd worked there 33 years, they were told there was just no money left for severance pay. Nothing.
After 33 years, no severance. How is that even possible?
Well, the creditors, the bankruptcy lawyers, the consultants, they apparently got paid first. Another employee, Kathy Copperwetz, 34 years on the job, was quoted saying, "We are leaving with nothing, and that is not a good feeling."
Leaving with nothing. Ugh. That just says it all.
It really highlights the human cost when these big financial deals go sour.
Okay, so job losses are one major documented impact. But the scorecard also flagged health and safety issues.
Big time. The sources pointed to OSHA violations, that's the Occupational Safety and Health Administration. Cerberus came up again with a high rate of serious violations, nearly 0.3 per 1,000 workers, mostly at Albertsons, the grocery chain they owned.
And Albertsons is huge.
Right. CD&R also had a high rate and reportedly paid the second most in fines per employee after Blackstone. And we should clarify what serious violation means.
Yeah, what does OSHA consider serious?
It means a hazard that's likely to cause death or serious physical harm. So we're not talking about minor slip-ups here. The data suggests real safety risks.
Okay, jobs, safety. What about wages? Were wage and hour violations part of the analysis too?
Yes, the scorecard looked at that based on public data about violations and settlements paid. The report listed firms like Rourke, Blackstone, CD&R with specific counts of wage and hour violations and the amounts paid out per worker. It indicates these aren't just theoretical concerns, they're documented issues.
So the picture from the scorecard and some of these other analyses, it's concerning across jobs, safety, wages, and even union activity.
Right. The scorecard mentioned BC Partners spent the most on so-called labor consultants, who are often hired specifically to discourage workers from organizing or joining a union. So yeah, taken together, these data points suggest a pattern, at least according to that scorecard report.
Now, one area that seems to be drawing a lot of concern lately, especially in some of the online discussions we reviewed, is healthcare.
Oh, absolutely. Healthcare is such a critical sector, and PE firms have moved in very aggressively into areas like nursing homes, emergency rooms, even specific medical practices.
And the outcomes.
Well, some are deeply worrying. One NBER working paper mentioned in the sources looked at nursing homes. It suggested a link between private equity ownership and a statistically significant increase in premature deaths. Their estimate was around 20,000 premature deaths over a 12-year period associated with PE ownership.
Wait, 20,000 premature deaths potentially linked to PE ownership in nursing homes. That's horrifying.
It's a shocking number, and it really underscores the potential stakes here. There's a specific case study highlighted in the sources involving HCR Manor Care, which used to be owned by the Carlyle Group.
Carlyle, another huge PE name.
Right. They bought Manor Care mostly with borrowed money and LBO. Then, according to the source, they sold off the company's real estate, the buildings themselves, and charged Manor Care significant fees, apparently over $80 million.
So hold on, the nursing home company now has debt from being bought, and it has to pay rent on the buildings it used to own, and it paid massive fees to the PE firm.
That's the structure described, yeah. It puts immense financial pressure on the operating company. And the source detailed a lawsuit involving a resident, Annie Sally. Her family alleged the facility was dangerously understaffed because of cost cutting. She needed help moving, was left alone, fell, hit her head, and tragically died after alleged delays in getting proper medical assessment.
That's awful. And was Carlisle held accountable?
This is a key point the source makes. Carlisle reportedly argued in court that they didn't technically own Manor Care. They just advised the investment funds that did. It was described as a legal disappearing act.
A legal disappearing act.
Yeah, basically using complex legal structures to distance the main PE firm from the actual operations and, crucially, from legal liability when things go wrong, even tragically wrong. It raises huge questions about accountability.
Wow. That insulation. That disappearing act.
Yeah.
That's a critical insight into how this works. The sources also mentioned concerns in emergency medicine.
Yeah, some online discussions pointed to this, particularly with companies like Team Health, which is owned by Blackstone. There's a concern, a perception at least, that there's a trend of staffing emergency departments with more mid-level providers, nurse practitioners, physician assistants instead of physicians.
And the thinking is that's driven by cost.
That's the worry expressed in the source. Mid-levels are absolutely vital healthcare professionals, but the concern is that they might be seen as a cheaper alternative to physicians who have significantly more years of training, especially for complex cases. There was even an anecdote, though just an anecdote, about 3 mid-levels allegedly missing a serious diagnosis, a pulmonary embolism.
So the fear is PE's focus on profit could lead to cutting corners on staffing, potentially impacting patient care.
While the PE firm itself might be shielded from the consequences, like malpractice suits, because of those complex ownership structures.
So that's a really serious charge, especially in healthcare.
It is. But it's really important, as recent analysts stress, to also look at the broader academic research. It offers a more, let's say, nuanced view than just these specific cases or the scorecard findings.
Okay, good point. So what does the academic literature say? It can't all be negative stories, right?
No, it's definitely more complex. Academic studies, like some published by the NBER or in finance journals, do suggest private equity can have positive effects. For instance, some argue PE improves corporate governance.
How so?
Well, by tackling what they call agency costs. In big public companies, you have managers running the show, but they don't own the company. The shareholders do. Their interests might not always align perfectly.
The managers might focus on perks or short-term goals instead of long-term value for owners?
Kind of, yeah. PE firms, because they take a huge ownership stake and get directly involved, can align those incentives better. They also might tackle free cash flow problems, basically, making sure the company uses its spare cash wisely instead of wasting it.
So the argument is PE brings discipline, better oversight, smarter capital use.
That's the positive case. And some studies do show performance improvements after PE buyouts, but, and this is a big but, the academic evidence is described as, at best, mixed on why performance improves. Meaning it's unclear if the gains are from genuinely making the company better, more productive, creating real value, or if they're just, transferring value from other stakeholders.
Squeezing workers on wages or benefits or cutting corners that hurt customers down the line.
Exactly. Are they growing the pie or just taking a bigger slice from others? The academic consensus on negative impacts on non-financial stakeholders, like employees, is at best mixed. It's not clearly proven one way or the other across the board, even if specific examples look bad.
Okay, so it's not a simple good or bad story academically. And you mentioned academics really stress the heterogeneity of PE.
Yeah.
What does that mean practically?
It means you really can't lump all PE deals together. The outcomes depend heavily on the type of deal. Was it taking a public company private? Buying a division from a larger corporation? Acquiring a family-owned business? One PE firm selling to another PE firm? These can all have very different impacts.
So the context of the deal matters hugely.
Absolutely. And different PE firms have different strategies, too. Some are known for operational turnarounds, others more for financial engineering, some hold companies longer than others. This variety, this heterogeneity, makes it really hard to make sweeping statements based on the academic evidence.
What about the jobs question from that academic viewpoint? We heard about the retail study, but what's the broader picture?
The academic studies on employment are also pretty mixed and vary by deal type. Some find an initial dip in jobs right after the buyout, but potentially stabilization or even growth later on. One really interesting finding from a study was that buyouts might lead to faster reallocation of jobs across the economy.
Reallocation,
Meaning, Jobs might shrink at the company that was bought out compared to its peers, but maybe grow faster at other companies, perhaps other firms the PE owner is involved with. It's less about just destroying jobs overall and more about speeding up the process of jobs moving between firms.
That's a much more complex dynamic than just PE kills jobs.
It is. And academics also caution it's tough to separate the PE effect from just general economic trends. Plus, there's selection bias. Maybe PE firms tend to buy companies that were already heading for trouble anyway.
Right, so the problems might have happened even without the buyout.
It makes isolating the specific impact tricky. And of course, the overall economy plays a huge role. Buyout activity booms when credit is cheap and easy to get.
More leverage, higher prices.
Exactly. When credit gets tight, PE might have to focus more on actual operational improvements rather than just financial leverage.
Okay, so bringing this all together, the worrying patterns from the scorecard in specific cases, the more mixed academic view, the complexity, it does seem to circle back to that idea you mentioned, the heads I win, tails you lose dynamic.
Yeah, that phrase really captures a central tension here. The way these deals are structured, using the acquired company's assets to secure debt, the management fees, the potential for dividend recapitalizations, it can allow the PE firm to extract value and profit significantly if things go well.
But if things go badly, like Toys R Us or HCR Manor Care,
Then, because of the debt load and the legal structures, the PE firm itself might be relatively insulated from the losses or the legal fallout. The company might go bankrupt, workers lose jobs and severance, patients might suffer. But the PE fund managers might have already made substantial returns through fees or earlier payouts. Critics argue this creates skewed incentives, maybe encouraging excessive risk-taking.
because the upside for the firm is huge, but the downside risk is largely borne by others.
That's the core of the critique. And given this, it's probably not surprising we're seeing more calls for accountability.
Like the labor scorecard pushing for change.
Exactly. And the online discussions showing public pushback. The sources mention potential solutions too, like changing laws to make it clearer that PE firms can be held responsible for harms caused by companies they control, trying to pierce that legal disappearing act.
And didn't you say the FTC is looking into this now?
Yeah, the Federal Trade Commission is actively seeking public comments on PE's impact across the board on competition, workers, consumers. So there's definitely increased scrutiny.
But we also need to remember the other side, right? The academic points about potential value creation, the argument that PE provides needed capital.
Absolutely crucial for balance. Not all PE activity is predatory. The academic view and voices in finance argue PE can improve companies, make them more efficient, allocate capital effectively, sometimes better than public markets. There's a legitimate role for it. The real debate is about distinguishing genuine value creation from simple value extraction or rent seeking.
Separating the productive from the potentially destructive.
Exactly. And understanding that the effects are, as the academics say, heterogeneous. It depends on the firm, the deal, the industry, the time period.
Well, this has certainly been a packed deep dive. It's clear private equity isn't some niche financial thing. It's a massive force shaping huge parts of the economy we interact with daily, employing millions.
And the picture is complex. We have academic research suggesting potential benefits to governance and efficiency, maybe performance gains. But then we have these other powerful sources, the labor scorecard, specific case studies like Toys R Us or Manor Care, raising really serious flags about the impact on workers' safety, wages, job security.
And that huge concern about accountability, especially in sensitive areas like healthcare, tied to those complex legal structures and debt burdens.
Right, that legal disappearing act and the heads I win, tails you lose potential creates this underlying tension. How are the incentives really aligned?
So to leave you, our listener, with something to think about. We've heard how PE strategies, often involving heavy debt and complex structures, are deeply involved in retail, food service, nursing homes, emergency rooms, potentially affecting millions of jobs and critical services. Given everything we've discussed, the safety concerns, the job impacts, the legal insulation, the drive for financial returns, how might this shape the quality of services you depend on? What does it mean for job stability in your community? Or maybe even the care available to vulnerable people? What does this powerful, often opaque force really mean for accountability in core parts of our economy?
Definitely something worth pondering long after this deep dive ends.